U.S. stock futures are steady following optimism over the U.S.-UK trade deal with all eyes on China trade talks this weekend. President Trump saying to, quote, buy stocks ahead of the talks this weekend. But is this a buy the rumor, sell the news event? Joining us now to discuss, we've got Brian Vendig, MJP Chief Investment Officer here. All right, so this is the second time in 5 months, essentially, maybe less actually, considering the inauguration at the end of January, that we've heard the president specifically either say or post on social media to buy stocks. What is the investor signal that they should actually be kind of paying attention to as we go into more talks this weekend?
Thanks, Brad. I think what investors really need to focus on are companies that are being clear and deliberate with how they're managing their businesses and how they're focusing on profitability moving forward. I think right now, when we look at the way earnings have gone, they've exceeded analyst estimates. The outlooks have been murky, and as a consequence, I think investors really need to focus on those forward valuations and how much they're paying for growth. Because right now, we're not out of the woods. I don't think it's necessarily a pound the table time to buy stocks per se. It's more of a jump ball right now for the markets to understand where these trade negotiations are going to go. The rhetoric over the course of this week from the administration has been more positive and forward-looking, talking about many trade deals that are going to happen over the next 60 days. That's what the market needs to hear. In the short term, I think still defensive positioning, thinking about the yield curve, being short duration on bonds is also something that makes sense, and being balanced between growth versus value, though growth stocks look a little bit more attractive, considering they've been taking a brunt of the disproportional punishment this year relative to coming into the year with higher multiples than other parts of the market.
And so what do investors do then, especially if the market more broadly is pricing in tariff relief before we actually get it, before we even hear of a lowered rate with regards to the U.S. and China? Then what happens to markets if that's the case?
Madison, I mean, that's a great point. I mean, I think if we start to see, again, more gradual progress on tariffs and those levels coming down, because as a friendly reminder to viewers, I mean, if you add up all the tariffs that were announced and then now are on pause, we were at levels that go back to 1901, and that is not where our economy is, with an effective tariff rate around 28.5%. So I think the process that supported those tariff announcements, I would say, was probably not the most strategic. Now those are being worked out. If that happens, then I think we're in this window where the economy has been damaged, but not permanently. And that's a good news item for investors, so that these concerns about recession over the next 12 months or so start to come down. I think then risk appetites increase. And you look at areas in the equity complex, such as mid-cap stocks, small-cap stocks, more cyclical focused stocks and industrials and financials, all catching a bid, knowing that economic growth is still here for the balance of the year, just more at muted levels.
Yeah, I can only imagine in 1901 what they would have done with the likes of Google search engine, or what they would have done with the Shein or Temu to cut down on some of their, fast fashion costs. All that considered and just aside, Brian, I wonder, what is the checklist, the investor checklist for actually seeing a good trade deal versus one that just feels like it's packaged up and promoted as a big win?
I appreciate that question very much, Brad, because let's be clear, the 10% tariff that is on imported goods, that's not going away. I think that's a minimal level that's going to remain. I think what investors need to realize is that China is going to have its own path that's going to be a little bit more elongated, and it's going to take a little bit longer, I think, to get to a strategic balance. However, other parts of the world that will follow, possibly the EU, India, Japan, these are things that we need to see come down to effective trade tariff levels, somewhere between 10%, 20% on average, I think, to feel a little bit more comfortable. But the biggest risk is time. If these things don't happen appropriately or efficiently over the next 60 days, the biggest risk to the U.S. economy, not only the psychological concerns around demand, but it's also inventory levels. And we've heard recently about Port of LA, the lowest level of Chinese imports and other goods coming in and just sitting there yet to be distributed because of the tariff concerns. Inventory levels in the U.S. supporting consumer demand is something to really keep a close eye on, Brad and Madison.
So if there are any rallies off the back of any announcements with China, obviously the president posting this morning that we could see a rate of 80%, but ultimately it's up to Treasury Secretary Scott Bessent. If we do get that lowered rate and we see a market rally heading into Monday, would you fade that rally?
I think in the short term, the answer is definitely yes. I mean, we have a more defensive positioning in our portfolios right now, but I would say we added to equities a couple of weeks ago when we saw valuations were a little bit more attractive, and also taking a view that we thought that trade negotiations would play out over the balance of this quarter. So right now, we're kind of holding steady, and I would say for investors that have not participated in the market rally, we still have enough back and forth that's going to happen over the next 2 months as we get to that July 8th termination date of the 90-day pause, that there's going to be opportunities to buy good stocks at attractive valuations. So I would say don't give up on the equity markets. And I would also say on the fixed income market side, rates are still elevated. Rates still look attractive on the short end of the curve. And that's probably a good place to be as well, just to be a little bit more defensive.
When you have this much of the institutional money that is cautiously optimistic, but expressing much more of the vocality around the volatility that they're anticipating, the potential downside risk, versus where some of the inflows have come in from retail investors, how do you kind of counterbalance or make sense of how that money is sloshing around, and ultimately, if that means there was a move to the upside, that we would have to see some type of short covering from some of the other institutional money that's knocking around?
Well, anytime you look for trends in the market over a very short period of time, Brad, I would just say the results are random. And right now, I think investors just need to be deliberate and purposeful with their portfolios, thinking about how much risk appetite are they willing to digest relative to their longer term goals. And in the short term, this volatility is not going away. Just as we saw earlier today with a couple posts from Trump, talking about China tariff rates, the market can move off of headline risk right now. And I would say the market's probably trading more on technicals and those headlines. I would feel a lot more comfortable in how asset flows are moving around if we get through this period and we get into July earnings with some better outlooks, because then I think you can be a little bit more deliberate on where you want to allocate from a risk perspective. And that's just our view right now, where we're in a little bit of a wait and see.
Brian, thank you so much. Really appreciate it.
Thank you.